In this video, I would like to talk about technical analysis. Now, what does that mean? Basically, it means chart analysis. And charts or chart analysis or technical analysis is used all the time when it comes to stocks, price developments, and so forth. So there is a whole theory about the past and how prices develop in the future, and there's a whole lot of models and so forth that can help you to determine what the future price of a stock might be. So let's talk about technical analysis in general. Okay, in general, you have a chart and you have prices of the past. And let's say, obviously there's all kinds of different indicators and so forth, and obviously we could fill hours and so forth, but I just want to give you the key factors when it comes to that. Let's say you have certain prices, and usually you have the last closing price of the day, and you have some stocks that develop in a certain way, and it gives you a chart. Okay, it gives you a price development, and you can go back certain days, months, weeks, and so forth, and you will see. Now, the first rule, and we talked about this in the very first video, is the trend is your friend. Remember, when things are going in this direction, that is a good sign, which means it's going up, and most likely, and nobody always knows what the future holds, but most likely things will continue to go up. Okay. The next thing, obviously, when things go down, then the trend is also going down, which means then it's not your friend, but when the trend goes down, most likely it's going to continue to go down. Okay, unless there is some other event. And remember, technical analysis is chart analysis, and fundamental analysis is about the company, earnings, earnings, price per share, all those kind of things, that how well is the company actually doing. But the chart or technical analysis has really nothing to do with how many sales the company has, how many profits and earnings and so forth. So it's really solely looking at the charts, at the prices of the past. And just as we talked about the trend is your friend, there's another saying that goes, never catch a falling knife, which means if the trend goes down, it will usually go down 3 times faster than it goes up. Okay, so never catch a falling knife that the trend is negative. But basically it comes down to this. It's a thing of supply and demand. If there are more buyers than sellers, the stock will move up. If there are more sellers than buyers, the stock will go down. And it's as simple as that. Let's talk about moving averages. What is a moving average? Okay, so let's say we have here the price development of a stock, okay? And it goes like this. And we have also what's called a average price, okay? And this is the moving average, which means basically this is the average price based on the development of the stock. So usually you have like a moving average that is 20 days, that takes the last closing prices of the last 20 days, some are 9 days, and then there is something which is called, and this is like a personal favorite of mine, which is called moving average divergence, so MACD. Basically, it's a combination of 2 different moving averages combined, one of 9 days, one of 20 days, and it's a very good indicator whether or not a stock will move up or down. Now, let me give you an example, very simple. Okay, so we have, let's say, this point here, okay? So we know this is the moving average. The stock fell below the moving average, but now it just hit the price here, which is basically a buying signal because chances are the stock will go up in that situation. On the other hand, right here, if the stock is falling below the moving average, it's an indication that the price will go down. So you can use a moving average to determine a buy signal or a sell signal. And if you have a moving average convergence divergence, that's actually a more accurate way, because you always have ups and downs, and sometimes it doesn't always mean exactly it goes up or down, but it means that there is a tendency that it will go either up or it will go down. And that will determine whether or not you should get in or you should get out. The next indicator you should look at is the volume, okay? So let's say you have a price, okay? You have a price, let's say here, $5.50 versus, here $5, 70, okay? So let's say that's your quote. And now what happens is you think that's a good stock to buy, but if there's no volume or very little volume, that means not very many people are exchanging or trading that share, which means chances are that once you get into that stock and there's little or no volume, that you cannot get out of it. So therefore, volume is very important. You usually want to invest into, whether it's a stock or options that have high volume, and I talk about 150% of what the average volume is. On a day like that, that is a good indication, because a lot of trading has happened, which means that's when you can get in or when you can get out, okay? So when you go into a stock and you buy a certain position, let's say you buy pink sheet stock, penny stock, but there is no volume, you cannot get rid of it because there's no market. There's no one who's willing to buy it from you, because at some points you want to sell it again, right? Because we buy it and we're going to get rid of it. But if there's no volume, it's not going to help. So when you have lots of volume, that's a good indication, and that's the only time when you should invest into whatever you invest into. So remember the volume. Then the next thing is, it's called a stochastics indicator. Now, a stochastics indicator, you can actually look it up when you go to Yahoo or whatever program you use or website you use to look at a stock, and you go into the charts, look at the stochastics indicator. And this is how it works. So we have here 25%, and here we have 75%. And it's an indicator that basically tells you whether or not a stock is overbought or oversold, okay? So which means if a lot of people just basically try to get rid of it, but it hasn't really been reflected in the price, then you know, you need to pay attention. Or on the other hand, when you know that you have a stock that's somewhat underbought, or that actually should be higher in price, then you can use the stochastics indicator to make the decision whether or not to buy a stock or to sell a stock. So moving average, convergence, divergence, the trend, and stochastics indicator plus volume will give you a pretty good idea whether or not you should get into the stock or get out of the stock. And then there's finally another factor, which is called fundamental analysis. And fundamental analysis means, does the company have good, solid numbers? Does it have good earnings, good, dividends, and so forth? Does it look good from a company point of view? And if the answer is yes, and if you have the right sector, trend, fundamental analysis, moving average, and volume, then you have a pretty good idea whether or not to get in or to get out. Well, you should also look at the sector that you're investing into. Let's say you invest into the automobile industry. And usually this is how it works. A lot of big institutional money, like pension funds, institutional investors, banks, and so forth, they will move into an industry or a sector. And what happens in the stocks of that sector, usually it goes up as well, because all of a sudden we have a lot of buying going on. If we have a lot of buyers, obviously, then it goes up. Now, with that, if you are invested into a single stock of, let's say, a motor company or a car company, then that's a good place to be because the trend, will help you to get, a good return on your stock, even though, let's say, your company in itself is doing not so well or average, but the whole market will help to move it up. But the same is true on the opposite. If you can see that all the institutional clients or money are moving out of that market or out of that industry, but your stock hasn't really, shown that in price yet, it's still at a good price, then you should sell because it's going to drop eventually, because once all that money gets pulled out, obviously it's not as attractive anymore and it will lose in value. So whatever industry or sector you're invested into, you should look at what's happening all around you, okay? So that will give you a pretty good indication whether or not to stay or to leave. Let's talk about when to keep a position or when to sell a position, okay? Because often people fall in love with a position that they've had for a long time and they have a hard time emotionally to let go. Because they hope somehow that the stock will recover back to the old level, and that's when they intend to sell it again, okay? So have you ever made that, choice? Let's say you bought a stock, let's say at $20, okay? And over time, it dropped to $10. But because you got so emotionally attached to it, you have a hard time. You think, when it gets back to $20, that's when I'll sell it again, okay? Now, let me ask you this. Let's say you are in that predicament and you say, well, I'm going to wait 6 months till it gets back to that level, or maybe 12 months and so forth. But usually what happens, it doesn't always happen that way, or it can even go the opposite direction, could even go further down to $5, okay? So wouldn't it make more sense to take a loss, to sell it, and to use that money and invest it into something that has more chances or faster chances that it could go up again in the near future, right? So let's say everything, or knowing everything that you know now today, that's the question. Would you buy the stock again at, let's say, $10? And if the answer is no, then you should sell immediately, cut your losses, and move to another type of investment, to another stock, okay? Because there are 13,000 stocks in the stock market that are listed. There's lots of choices, and just because that one didn't move fast enough doesn't mean that you should stick with it just because you're emotionally attached. Let's talk about some rules that you should have for your money management or investment. Let's say you buy a stock at $10, okay? And you should make, right from the start, you should always use a stop loss order, which means about 10 to 20% below the current price where you bought it. So let's say here at, let's say $8.50. This is where you immediately, when you hear put in a buy order, where you immediately put in a sell order. So if the stock doesn't drop to $8.50, then it doesn't get executed, right? So your sell order will only get executed if it actually falls in price. If it falls down below that price, then you know you made the wrong choice. You only lost, 15% in that case. It's not the end of the world, and then you can move on to a different kind of investment. If it goes up, let's say it goes up to, $13, then you can delete the sell order and you can move it up, let's say to, $11, for example, and you put in the sell order for $11. And again, it doesn't get executed unless it drops down to that level, okay? So always use a stop loss order. Now the other thing is too, let's say your stock goes from $10 up to $20. So you make 100% profit. Now, once you make 100% on a single position, and this is where some people really have to listen, you need to sell it, okay? Because no matter how attractive it looks, even if it might go to 30 or 40 or whatever, it might go more up, most of the time you miss the point and it falls back down, it goes down maybe, to $2 and you lost 80% of your money. So that happens quite a bit. So make a deal with yourself that no matter how good a position looks, when you reach 100% performance, that's when you sell, no matter what. And if you want to reinvest, then you can reinvest, you can look at it again, but you should then take out the money, cash it out, and just wait a day or two before you reinvest. Now the next thing is, and this is also important to know, I had a friend, a very close friend of mine, and his wife had a house, and he sold her house, and they had about $100,000 cash sitting in an account. And he loved to trade with options. So what he did is he started to trade with options. He made some money. He made like 20, 30 grand in a matter of a few weeks or months, very short period of time. And then he got cocky. He started to risk more. He started to invest more and so forth. But all of a sudden, he was down to about $50,000. And then when he was at $50,000, he said, no big deal. I can, win it back. And he started to invest more and more. But he got even more aggressive with his investments. He believed in certain things so much that he just said, this has to go up. I know it. I feel it. It must go up. And what happened? He fell eventually down to $20,000. And eventually he fell down to $10,000. Because what did he do? He started to take, before he started with maybe $5,000 per position that he bought. Then when the stock went down, he got more, he felt he needed to risk more. He started to risk $10,000, $20,000, $30,000. And so eventually it all went down because he was wrong, because someone is always right and someone is always wrong. So therefore, at the end, he lost everything. And he came to me and he said, hey, can you not give me like $50,000 so I don't have to tell my wife and I can make up for it? I said, listen, it's probably best you speak to your wife because, with your attitude, with your emotions and so forth, you risk too much and you don't know what you're doing and you start to lose more and more money. It's not going to happen. So here's the rule or the lesson I want to give you. When you invest, especially into like options or things like that, don't invest more than 5% in a single position of what you have available to invest. Because if you're wrong, and chances are that from time to time you're wrong, then you only lose 5% of your entire portfolio. But if you start investing 20, 30, 40% of whatever you have available into one position and that position goes down, then you're screwed, okay? So therefore, the rule is never have more than 5% in one single position. Let's talk about short selling one more time, okay? Because short selling is a strategy that you can use when you believe a market or a stock is going down. And let's say you buy 100 shares of ABC stock or ABC Corporation, okay? And let's say you buy the stock at $50 per share. Now, you are hoping that the stock will go down, and let's say it goes down to $20. And if you do short selling, which means you sell it here and you basically buy it back here, then your profit is $30, right? Okay, but how can you actually sell something that you don't own? Well, it's possible. I told you there's about 13,000 stocks that are listed and about 3,000 stocks of them that have options, and some of them are actually you can short them, okay? So what happens is, depending on what kind of stock and so forth, but most stocks you can short, which means you can get the stock somewhere else. Basically, your brokerage firm can loan the stock somewhere else, and then basically they close the transaction later on when you close the transaction and then you make the profit. But let's say you ordered a car at the dealership, right? So, and you want a specific model with all these features and this and that. and extras, but the car actually doesn't exist yet. It still has to be produced first. And so the dealership can already order your car, and then maybe in the future, a couple of months in the future, they can deliver the car. And this is the same scenario here. And it happens everywhere in life. So short selling is a very normal way of trading stocks. So most people, when they believe something goes down, they will short sell a stock. Now, short selling also comes with risk. And the risk is that it's potentially unlimited because the stock can go up. And in that case, the risk is unlimited because it can go up to thousands of dollars, theoretically, right? But so therefore, when you do short selling, always make sure that you protect yourself and you know what you're doing. And in most cases, you should consult someone like a professional before you actually do it.